Hello and welcome to this week's ITPM Flash. My name's Ed Shek and thank you for joining me. So today's title, Where Have the Big Buyers Gone, couldn't have come at a better of time. It's Saturday the 4th of November. And of course, some of you may be thinking, well, Ed, I know where the big buyers are. They're in the equity markets. Haven't you seen a decent rally over the last 5 days? And of course I have. But the two big buyers that I'm talking about are the ones that have been the huge silent buyers that have been in the markets persistently for the last 15 years, ever since the great financial crisis. And of course, what we're really discussing is whether or not yields falling a little bit, peak rates terminal rates probably having been hit, is enough for a sustained earnings recovery. Now, the two big silent buyers have been the asset allocators and the corporates themselves, the buyback. So when you look at one of the biggest mistakes that I think is easy to make at the moment is just thinking that equities rally on falling yields. It's the reaction function that we've had since QE. And you'll say, Ed, you're talking about QE. This is so old. We haven't had QE for 16 months, 18 months. And of course, you're right. But of course, just because we get to terminal rates doesn't mean that rates are now easy. Okay? It doesn't mean we've beaten this rapid rise in rates. And when you look at this chart, now this is just an expression of the equity risk premium. You can clearly see that fixed income is as attractive as it has been for over 20 years relative to equities. And of course, rates have only been restricted for about 5 months. So we've had 15 years of ultra-loose policy, and now we're 5 months out of the other side. So when I hear the narrative that, well, look, the markets are fine, we've priced in, we can handle rates at this level, I think that's very premature because the tightening's only just started. And this chart reflects that. So even with this week's falling yields, the equity risk premium is incredibly low. Now, of course, just because equity risk premium is low doesn't mean that equities can't go up. But the point I'm making is that it can only really go up if earnings deliver. So when you think the market's expecting an 8% earnings recovery sequentially from the season that we're in now, and 10 to 12% increase in 2024, that's quite a big number. The equity market is pricing in a real improvement in corporate earnings. And of course, we've only really just started tightening. So coming back to what I alluded to begin with, we understand the reaction function of the data we've seen this week. Yields fall. A lot of stocks look very oversold. The chartists are in there. Yields fall. And of course, the market rallies. And that's fine. I get it. But can you imagine now that the economy is slowing and if the rates of change continue, and when you try and think, well, does that mean earnings are more or less likely to go up 8% next quarter and 12% the next year? That's a decision you have to make. And of course, we're always looking for rates of change. And the next PMI, services and manufacturing, will be extremely important. Because if we take the services falling from the 53s to the 52s, of course, that looks like soft landing data. But if the next set gets back towards 50 or below, that's going to make the asset allocators look very carefully at the chart that I've just shown you. And the following chart is just another illustration that the tightening's only just started. And if it's already slowing down the economy quite dramatically, one has to worry about the rate of change because the tightening is not going to stop just because we think we're at terminal rates. Now, the second big silent buyer has been corporates themselves. The biggest buyer of US equities since the great financial crisis has been the corporate buyback. And what a time to be in the C-suite. When you have a look at this chart, you can see the rise of aggregate buyback in notional. You can see it's currently recently peaked out at over $1 trillion. Now, when I said what a time to be in the C-suite, imagine a set of circumstances when your earnings yield might be 7, 8, 9, 10%. You can borrow as much money as you like at 3, 4, 5%. That's lovely, simple, legal financial engineering. You borrow as much debt as you can, you buy back your shares, you drive up your earnings. And you're doing this at a time when asset allocators are pouring out of fixed income into equities. So you've got two huge silent tailwinds. Even if your revenue and earnings don't change, if you're doing a buyback, at least your earnings are getting driven up, your rating expands. So when you look at the corporate credit spreads over this time, obviously you can see the two bouts of distress post the great financial crisis. And then of course it took the markets longer to realize that rates were actually going to get driven down to unbelievably low levels. Borrow lots of money. You can see the AAAs there. You could borrow money at 2, 3, 4% from the great financial crisis into the pandemic. And then, of course, your earnings yield is likely to be higher, and it's just financial arbitrage. And now, of course, we've had the pandemic, and you can see that rates got even lower. And now we've had a rapid increase that we all understand. So what I'm saying is now, for a lot of companies who are able to do buybacks when perhaps they ought not to have been, now it's much harder to justify. Because now the cost of capital might be very close or even higher to your earnings yield. Now, as much as the C-suite should still want to do buybacks for driving their stock price up, it could be starting to become value destructive. So the real takeaway here is that peak conditions for buybacks, I think, are behind us. And of course, you're looking at earnings season now, and we're seeing about new buybacks in cash generative sectors. That will continue. The buyback's not going to stop. But we've just got to understand what a big tailwind it has been. And when you look at the chart of buybacks versus the S&P, of course, there are many other factors, but it's about not underestimating the second massive silent driver. So the conclusion today really is that the conditions for both of these two big silent tailwinds are changing. They've become much less supportive. And in my opinion, it wouldn't take too much more of a deterioration in the macro for these tailwinds to actually become headwinds. Buybacks become less and less. Asset allocation may really start. So if the earnings get downgraded, which of course they are likely to do if the economic slowdown persists and actually becomes negative, then the market could look and feel and trade quite differently. So thank you very much. All these sort of conversations, if you like them, you want to continue them, you know where to find us at the ITPM. Good trading.